If you're new here, make sure to hit the like button and subscribe because it really helps the channel and lets us keep bringing you deep, data-driven stock analysis. Today, we are unpacking Ford, a century-old icon that is trying to write a new chapter in the EV era while defending a still powerful gas and hybrid portfolio. This is a pragmatic, numbers-first narrative that blends Ford's most recent quarter, the strategy behind its next wave of products, and the risk factors that matter most for investors right now. Ford's latest print anchors the story. In the second quarter of 2025, Ford reported roughly $50.2 billion of revenue, up around 5% year over year, and delivered about $2.1 billion of adjusted EBIT, despite an unusually heavy tariff headwind in the period. Management reinstated full-year guidance and declared a regular 15-cent dividend for the third quarter, signaling confidence in cash generation even as macro and trade pressures bite. This is the first place to look when judging whether the turnaround is real. The company is growing the top line, protecting profitability with cost cuts, and keeping the capital return drumbeat going, all while absorbing hundreds of millions of dollars in incremental tariff costs. Under the hood, Ford Pro remains the profit engine and a structural differentiator. This commercial division is where trucks, vans, service, parts, charging, telematics, and software come together, producing durable margins and sticky relationships. In the quarter, Ford Pro's paid software subscriptions grew about 24% to roughly 757,000, and the segment generated approximately $2.3 billion of EBIT, evidence that the flywheel of vehicles plus high-margin services is working. That cocktail of hardware and software is critical because it lowers cyclicality, raises switching costs, and supports a higher blended multiple over time. On the sales front, the US business showed real muscle. Ford sold over 612,000 vehicles in the second quarter, up more than 14%, taking share in pickups and leaning on a deep bench of nameplates. F-Series deliveries topped 222,000 units, up by double digits, while Maverick posted an all-time best quarter. Those results underscore the continuing strength of combustion and hybrid trucks and the advantage of a broad, well-known lineup when financing costs are high and consumers prioritize practicality. The EV story, however, is a tale of two timelines, near-term turbulence and a long-term reset. In the second quarter, Ford's US EV sales fell roughly 30% to about 16,438 units as the Mustang Mach-E recall and 2025 model changeovers constrained supply, with F-150 Lightning also weaker. That is the bad news investors already see in the tape. The good news is that Ford's broader electrified tally, hybrids and plug-ins, grew mid-single digits, and management is pivoting the pure EV roadmap toward cost, manufacturability, and price points the mass market can actually afford. This pivot is not incremental. Ford has unveiled a universal EV platform and production system aimed at a $30,000 mid-size electric pickup launching in 2027 out of Louisville. The plan is to shrink parts content by about 20%, cut fasteners and workstations materially, and compress assembly time using a modular assembly tree approach rather than a single moving line. The target is compelling: more interior space than a Toyota RAV4, Mustang EcoBoost-like performance, and a total cost of ownership that can undercut a Tesla Model Y in the right use case, all while bringing EV pricing closer to where average Americans can buy without heavy incentives. If Ford executes, this becomes a Model T-style cost breakthrough for the EV age and could reset adoption curves in work and family segments. The ambition is backed by billions of dollars of investment in retooling Louisville and growing battery capacity in Michigan. Investors should also factor in the Blue Oval industrial footprint that supports this transition. Tennessee's Blue Oval City remains one of the largest manufacturing bets in Ford's history, pairing assembly and battery operations at massive scale, though timelines have shifted as management prioritizes hybrids and profitability while the low-cost EV architecture takes shape. The broader point is that Ford is re-architecting both product and process, not just releasing a new model. This matters because persistent cost gaps have been the Achilles heel of legacy OEM EVs. None of this erases the math of 25. Tariffs are real and rising, with management now planning for about $2 billion of net tariff costs this year. And guidance for adjusted EBIT is a notch lower than last year's delivery. Free cash flow guidance sits in the mid-single billions even after the trade headwind, and Ford continues to pay a regular dividend. But the dividend policy has drawn scrutiny from the financial press because, year to date, cash out the door for dividends has run ahead of adjusted free cash flow, and payout ratios look stretched if you benchmark against traditional cash metrics rather than Ford's adjusted definition. That does not mean a cut is certain. It does mean income investors should watch cash conversion and tariff developments closely. Where does this leave the equity? Start with positioning. Ford trades at a single-digit earnings multiple and a modest price-to-sales ratio that reflects skepticism about EV profitability and macro cyclicality. The bull argument is that Ford Pro's software and service flywheel, a resilient franchise in trucks and vans, and a credible low-cost EV plan can bend margins up and support a re-rating. The bear argument is that EV unit economics stay tough longer than planned, tariffs remain a multi-billion-dollar drag, and the dividend constrains flexibility if auto credit or demand stumbles. Both sides have receipts. The right stance depends on your time horizon and tolerance for execution risk. Let's dig deeper into the operating model because that's what will decide which narrative wins. The commercial franchise is structurally attractive. Businesses buy for uptime and total cost of ownership, not novelty, and they renew fleets on predictable cycles. Embedding software for telematics, route optimization, maintenance, and charging coordination into that fleet relationship creates high-margin, recurring revenue that scales with the installed base. As the paid subscription count in Ford Pro rises, from roughly 750,000 today toward a future horizon in the millions, the segment's EBIT mix tilts towards software and services, dampening cyclicality and raising return on invested capital. If you believe that thesis, Ford's sum of the parts carries more quality than the headline multiple implies. In retail, the hybrid bridge is doing real work. Hybrids and plug-ins offer fuel savings without range anxiety or charging friction, and they can be built profitably using existing supply chains. Ford's second quarter electrified sales growth, even as BEV volumes slipped, signals that consumers still want efficiency and technology just at the right price and with familiar ownership. That gives Ford time to execute the 2027 Universal Platform launch while keeping showrooms busy with high-demand Mavericks, Broncos, and F-Series variants. If rates ease into 2026 and incentive normalization continues, unit elasticity on these nameplates can extend the cycle. The most important strategic swing is manufacturing simplification. High-pressure die castings, consolidated wiring, fewer fasteners, and modular sub-assemblies can remove dozens of minutes from takt time and hundreds of dollars from bill of materials on a per-vehicle basis. Ford is targeting double-digit percentage reductions in parts and workstations on the Universal Platform, exactly the kind of compounding efficiency needed to close the cost gap versus the EV leader and blunt the threat from low-cost entrants. Combine that with domestically sourced batteries designed for lower material intensity, and you have a plausible path to competitive contribution margins at a $30,000 sticker. Execution risk is significant, but the vector is right. Technically, the stock has been basing in the low to mid-teens. Relative strength improved into mid-summer as tariff expectations were absorbed and the market looked ahead to Ford's August strategy event. A decisive breakout above the $12 area on expanding volume would confirm accumulation and open a path toward the mid-teens. Failure to hold key moving averages would keep the trading range intact and invite tests of high single-digit support if macro data sours. For long-only investors, this is less about trading levels than risk budgeting. Add on weakness if the long-term thesis remains intact and trim into strength near the top of the recent range while catalysts are still futures dated. Risks deserve an unvarnished look. First, the tariff overhang is large and not fully under Ford's control. A $2 billion net hit is meaningful even for a company this size. Second, EV execution risk is real. The company lost serious money in its EV segment last year and must prove that the universal platform translates from slides to factories to showrooms on time and on budget. Third, dividend optics could grow louder if cash conversion wobbles, particularly if auto credit tightens or incentives rise. Finally, competition is accelerating at all price points, from aggressive Chinese OEMs internationally to our revitalized Detroit peer set and software-centric players at home. None of these are deal breakers. They are the price of admission to a turnaround. Now the upside. Ford has a fortress of brand equity in trucks and performance, a distribution and service network that spans the continent, and a commercial platform with real software traction. US sales momentum in key nameplates continues to be strong. The company is cutting costs for the fourth straight quarter ex tariffs, and it has articulated a concrete cost-first EV plan with a date, a plant, and measurable manufacturing targets. If the macro cooperates and Ford hits its manufacturing milestones, the next 18 to 24 months could mark the inflection when investors stop asking whether Ford can make money on EVs and start modeling how much. I view Ford as a buy for patient, value-oriented investors who can tolerate execution noise and who want exposure to a credible low-cost EV strategy plus a resilient commercial franchise. My base case 12 to 18-month target band is $14 to $16, anchored on mid-single-digit revenue growth, stable North America margins, Ford Pro mix expansion, and steady free cash flow inside their instated guidance. The bull case, which assumes tariff pressures ease, the stock confirms a breakout above recent resistance, and the universal EV platform narrative builds through pilot milestones, supports an $18 to $22 range. The bear case, where tariffs stay elevated, EV losses narrow slower than planned, and dividend controversy weighs on sentiment into a softer auto tape, implies downside to $8 to $9 near prior support. Position sizing and patience are your friends here, and so is watching the cadence of Ford Pro subscriptions, US share in trucks and hybrids, and concrete progress updates on Louisville's universal platform build-out. And if you found this helpful, remember to like and subscribe so you do not miss the follow-ups as new data land.